What an absolute mess. Interest rates at 7.5, 7.7, 7.8% or so, 23-year high, wars breaking out everywhere, the bond market going crazy. What's it all mean for interest rates? Let's unpack. Welcome to Dre's Take. So this week, as you may know, interest rates have met a 23-year high, coming in around 7.5%. I'm seeing most folks get quoted closer to 8%, and it's really putting a lot of pressure on buyers. Some even just leaving the market altogether and really hindering demand. Now, that's obviously what the Fed wants, as their aim is to slow down spending in all sectors, essentially, to get a handle on inflation. How it all works out in the long term and whether or not the decisions made today are going to benefit us or hurt us is yet to be seen. But one thing we do know is that at least two officials from the Federal Reserve are calling for no more rate hikes, saying that a surge in long-term interest rates will fight inflation and negate the need for further rate hikes. Now, obviously, these are just two officials. It's not a final thing, and we'll have to wait to see what the big dog Jerome Powell says at the next meeting. Federal Reserve rate hikes obviously play an indirect role in mortgage rates, but more importantly is the bond market. And something interesting about the bond market is we've got about a third of all outstanding U.S. government debt due to mature within the next year. That's putting upward pressure on rates as well. And it's just so topsy-turvy. Normally you would think with all the foreign conflict that's going on and uncertainty in the markets that investors would push bond prices up as there would be a lot of demand and therefore the yields down and therefore interest rates down. But the unprecedented issuance of new bonds is actually working counter to that philosophy. And so what you're seeing is lower prices actually and higher yields on these bonds and subsequently higher mortgage rates. It's all upside down and who knows where the heck it's gonna go from here, to be totally honest. So what's a buyer to do right now in the face of these high interest rates? Well, you may have to make some compromises. Obviously a less expensive house or different type of house could be an idea. Or, in my opinion, I think looking into the new construction route may be the best option. You may have to add some time to your commute because it's going to be a little further out than maybe you want to be, but that may be the lesser of two evils when it comes to getting a hold of an asset, fixing your living expenses, and preparing yourself for the future. Right now, many of the new construction builders are offering incredible incentives, not only paying off closing costs, etc., but also by using their preferred lender, they're able to buy down interest rates or offer lower interest rates. I'm seeing interest rates anywhere from 4.875% on the lowest end to about 6% or so with some of these new builders who are offering these incentives. You wonder how they may be able to do that. Well, that's because their primary objective is to move inventory. By having in-house lenders, they can take the loss on the lending side in order to make the profit from the sale of the inventory. So they've got a bit of a built-in advantage there over most lenders. If going new construction is something you might want to pursue, feel free to give me a call. I'd be happy to connect you and introduce you to these builders that are offering these great incentives and interest rate options. And I just love to tour new construction anyway. It's always good to see what the new design and what the new features are that these guys are trying to bring to the market. It's probably one of my favorite things to do. Well, going forward, we'll see what happens, but as of now, that's Dre's Take. I'll see you next Wednesday. Take care.